Good morning and welcome to the Bulls, Bears, and the Bell morning edition of the Deep Dive. Thank you for joining us.
Good morning.
Our mission today, well, it's a crucial one. We need to dive deep into today's pre-market briefing. It's Wednesday, October 22, 2025.
That's right.
And you might be looking at the screen right now seeing a pretty muted, sort of mixed open.
Yeah, looks calm.
But that surface tranquility, it's completely deceptive, isn't it?
It truly is. It really is. A calm before the storm, or maybe, a calm during a really complex internal weather event for the market.
Internal weather event, I like that.
Because if you just look at the headline futures, you might think, okay, business as usual.
Right.
But underneath that, the market is profoundly bifurcated. That's the word for today.
Bifurcated. Okay, explain that. What does that mean in this context?
It means we've got two really powerful opposing stories, opposing narratives, battling it out. And they're pulling different sectors in radically different directions, sometimes, quite violently. Okay, let's break down that core divergence right away then. What are the two sides?
Well, on one side, you've got incredible strength. That's providing a pretty significant bullish anchor.
Okay.
You see in the Dow Jones Industrial Average, that benchmark for, mature industrial America, it's hovering right near record highs.
And that's driven by?
It's absolutely buoyed by robust real money earnings. We're talking about the old economy bellwethers.
Like who?
Think General Motors, think Coca-Cola. They're delivering results that just scream current profitability, strong cash flow, real operational efficiency, stuff the market loves right now.
Okay, so that's the bull case, the strong side. What's the counterweight?
The heavy counterbalance is pretty brutal, actually, a severe and purely macro-driven sell-off. It's focused entirely on the materials and mining sectors.
Why them specifically?
It's being fueled by a really dramatic and sudden collapse in key commodities, particularly precious metals. We'll get into the details, but it's sharp.
Got it. So when we see the S&P 500 kind of struggling or flatlining like it is now.
Exactly. It's not because everything's just okay. It's because the strength of industrials, like GM, is being almost perfectly canceled out by the weakness in materials.
These cross currents, then, they're creating a really unstable equilibrium.
That's the perfect way to put it. Highly unstable.
And then looking at the calendar today, there's almost nothing on the economic front, right? Very light.
Extremely light. Almost no macro data that's likely to shift the overall tide.
So what does that mean for trading today?
It means we need to establish right now this is going to be a classic stock picker's market.
That phrase gets thrown around, but you're saying today it really matters.
More than ever. Idiosyncratic news, company-specific stuff, corporate fundamentals, those specific catalysts, they are going to dominate sentiment today, not the broad sector averages.
So your success today, if you're trading, depends entirely on recognizing which side of that bifurcation a company sits on.
Precisely. Are you linked to commodities, or are you delivering profits like GM? That's the question.
Okay. Let's dig into the macro pulse then. Navigate this tepid open. Let's start with the futures numbers.
Right, the hard numbers signaling this consolidation phase.
As we're watching the screen, Dow Futures Mini barely moving, up, 0.01%, holding steady.
Yeah, basically flat.
The tech-heavy NASDAQ 100, slightly positive, plus 0.06%.
A little bit of green there.
But the broader S&P 500 E-mini, that's signaling a bit of a drag. Down 0.11%.
So definitely mixed.
Absolutely mixed.
Yeah.
And it feels like it's leaning towards consolidation after the Dow's big push to record territory yesterday.
That makes sense. But what's really fascinating here is understanding the mechanics behind those muted futures.
Go on.
It is literally the average of massive capital movement happening underneath.
Okay.
Our sources are pointing directly to a powerful sector rotation. Money isn't just, fleeing the market, it's repositioning.
Where is it going?
Capital is flowing decisively out of those commodity-linked materials.
Right.
That's the area feeling the acute macro pain we talked about. And it's flowing into defensible industrials and established consumer staples.
So the GMs, the Cokes.
Exactly. The companies that have already demonstrated proven earning strength. Like those blockbuster GM results, we're definitely going to unpack later.
So if you're listening, the key point here is this is not a broad risk-off event. It's not like institutions are just liquidating everything and running to cash.
Not at all. It's highly targeted. It's strategic flow. You've got a clear flight to quality, but it's within equities. Shifting towards companies with demonstrable, maybe less cyclical earnings power.
And at the same time.
And conversely, you see an equally sharp flight from risk that is absolutely punishing anything directly sensitive to commodity pricing or, frankly, global demand signals.
Okay, so this tactical rotation, these two opposing forces, that's why the Dow is holding up so well, while the broader, more diversified S&P 500 is kind of struggling to find direction.
You nailed it. That's the dynamic creating this mixed picture.
And that distinction, that flight from commodity risk, takes us directly to the main negative catalyst this morning, the commodity collapse.
Yeah, it was stunning, really stunning in its speed and severity, particularly in precious metals.
Gold specifically.
Gold experienced what our source material is calling its biggest daily drop in years.
Wow. After building for weeks, right? That rally looked pretty strong.
It did. It had momentum, but it just stalled and reversed violently.
Right. Talk about the technical levels. That makes the reversal really painful for anyone who was long.
Incredibly painful.
Yep.
Gold had been pushing up towards that significant overhead resistance level near $4,400. That's a level that often brings out sellers, profit-taking.
Okay.
But instead of just consolidating or pulling back gently, it fell sharply through the crucial $4,200 support line.
Ouch. That's a big level.
Huge level, and it's now trading around $4,100. When you slice through major support like that, it often triggers a cascade of stop-loss orders from institutional funds.
Amplifying the selling pressure.
Exactly, just making it worse. And silver, well, silver is always more volatile.
Right.
It experienced an even more pronounced drop, tumbled below the key $50 level, just a bloodbath in metals.
And the swiftness of this reversal, you're saying that's the direct trigger for the big risk-off move we're seeing across all the materials and mining stocks.
It's the direct trigger.
Yeah.
Think about it. When the underlying asset, the gold, the silver, the iron ore, drops that quickly, the companies that spend all that capital and energy digging it out of the ground, they get instantly derated.
Their profit margins just get squeezed overnight.
Instantly compressed by the spot price movement. That's precisely why the entire sector basically landed on our pre-market losers list this morning.
Okay, so that's the commodity story. But moving on from that, we also have these persistent financial sector concerns. They just keep bubbling beneath the surface, don't they? Threatening to undermine confidence even while the broader equity market seems resilient.
They really do. Despite some recovery we saw recently in regional banks, those deep-seated worries about credit quality, about systemic stability, they're still very much present.
And there's a specific source for the anxiety right now.
Yes, it's tied to some recent pretty disturbing reports. Details coming out about bad loans linked to possible fraud at regional lenders. Names like Zions and Western Alliance were mentioned.
And when the market hears the word fraud connected to lending,
Yeah, it naturally raises broader fears. Is this more widespread where lending standards too lax across the board? It definitely brings back some painful memories of, previous credit cycles.
and then you had Jamie Dimon, CEO of JP Morgan, amplifying that concern. His cockroach warning is still echoing.
Right, and he wasn't speaking lightly there. He was hinting that, when you find one hidden problem like a cockroach.
There are probably more you haven't found yet.
Exactly. More hidden credit issues lurking, maybe in commercial real estate, maybe in consumer lending portfolios, somewhere within the broader banking system.
And we can actually see this anxiety in the charts, right?
Oh, absolutely. You can track it in real time. Look at the SPDR, S&P Regional Banking ETF, the KRE.
Okay.
It had already marked 4 consecutive weeks of declines leading up to this point. And now we're seeing those sell-offs start to extend into major European banks as well.
So it's not just a U.S. regional bank issue anymore. It's potentially a global credit quality concern.
That's the fear. The market understands that while the Federal Reserve might be trying to stabilize liquidity, the underlying credit picture, the actual quality of the loans on the books, that remains shaky.
And this uncertainty, it forces traders to seek refuge elsewhere.
Precisely. It pushes them towards high-quality, non-financial earnings, which again just reinforces that sector rotation we talked about earlier, away from financials towards proven earners like GM.
Okay, so let's pivot to the really crucial question then. Why is the equity market, specifically the Dow, staying so resilient despite this whole laundry list of headwinds? We've got banking worries, the commodity collapse, geopolitical stuff.
Right, it seems counterintuitive.
What's holding it up?
The answer seems to be a heavy, almost near-total reliance on the expectation of forthcoming monetary easing from the Federal Reserve.
Ah, the Fed put or the expectation of it?
Exactly. That anticipation is acting as the market's perceived safety net.
Is there a way to quantify that expectation?
There is. Traders are currently pricing in 53 basis points of rate cuts by the end of this year.
So more than 2 quarter-point cuts fully baked in.
Fully expected to arrive. And that sentiment got a major boost recently from comments by Fed Governor Christopher Waller.
What did he say?
He suggested that cuts could continue, specifically to support a weak labor market if needed.
Okay, so Waller's comments basically act as this huge psychological backstop for the market.
Immensely powerful. It essentially tells the equity market, look, don't worry too much. If the economy slows down, the Fed will be there to, juice the system with cheaper money.
But here's the vulnerability, right? And this is critical for you, the investor, to grasp. The market's valuation right now, you could argue it's subsidized.
That's the perfect word. It is subsidized.
Yeah.
It's subsidized by the anticipation of cheaper money, not solely, maybe not even primarily based on robust, unaided corporate fundamentals.
Can you unpack subsidized valuation a bit more? What does that really mean in practice?
Think about it like this. When investors expect interest rates to fall, they become willing to pay a higher price for a company's future earnings.
Why?
Because those future earnings get discounted back to their present value using a lower discount rate. Lower expected rates mean future profits are worth more today.
Got it. So the expectation of lower rates inflates the present value calculation.
Exactly. And this phenomenon creates a kind of floor under the market, even if the current economic data isn't actually that great.
But historically, relying so heavily on central bank promises, that can make the market really brittle, can't it?
Extremely brittle. Any hint that the promise might be broken or even just delayed can cause an outsized negative reaction. The market isn't reacting to the economic reality at that point. It's reacting to the potential loss of its subsidy.
And that structural subsidy, that safety net, it's facing a major test this week.
Huge test. The crucial data point is the Consumer Price Index, CPI inflation data coming out on Friday.
What's the risk there?
If CPI comes in hotter than expected, if inflation proves stickier than the market hopes, it immediately challenges the Fed's ability to actually deliver those 53 basis points of cuts they've priced in.
And if that safety net gets challenged,
Then that subsidized market valuation is suddenly exposed.
Yeah.
It could lead to a very sharp, very technical correction, as all those expected future earnings suddenly need to be discounted back at a higher, more realistic interest rate. The air comes out of the balloon fast.
Okay, so a lot riding on Friday's CPI. Now, adding more layers of complexity here are the external factors. Geopolitics.
Right. Starting with geopolitical instability, we're seeing persistent volatility caused by President Trump's comments regarding tariffs, the ongoing U.S.-China trade tensions.
These high-stakes, sometimes off-the-cuff remarks, they cause intraday swings.
Absolutely. Rhetoric changes, maybe a tweet comes out, and the market swings. It makes strategic planning incredibly difficult for companies with complex global supply chains, adds a layer of constant uncertainty.
And compounding all this confusion is the ongoing U.S. government shutdown, now in its third week.
Still chugging along, yes.
Yeah.
Third week. And this shutdown has created a significant data vacuum.
Explain that. When the government stops operations.
The release of key economic information just halts. And for a deep dive like this, we need to understand which missing data points are creating the most opacity, both for the Fed and for us market participants.
So what are we missing right now that's critical?
Well, we're missing critical updates like housing starts, detailed consumer credit reports, granular retail sales figures.
Things that tell us about the health of the consumer and the housing market.
Exactly. Areas where the Fed really needs precise, timely information to calibrate its policy decisions. Without this data, the Fed is, well, flying partially blind. They're relying more on lagging indicators or anecdotal evidence.
And for traders, what does this opacity mean?
It means decision-making gets harder, risk management becomes absolutely paramount, and importantly, it means those individual company stories, the earnings reports we're about to discuss, they gain disproportionate importance.
Because they're the only reliable source of ground-level information available right now.
Pretty much.
Yeah.
They offer a glimpse into actual business conditions when the government data stream is cut off.
Okay, let's pivot sharply then. Away from the heavy macro cross-currents, the banking fears, the gold collapse, the shutdown, and let's talk about the sheer power of micro-triumphs.
Yeah, the specific company wins.
Because despite all that fear and uncertainty, we still have incredible strength in specific corners of the market, which proves your point about today being a stock picker's dream.
Absolutely.
And our undisputed star gainer this morning, the biggest bullish driver for the Dow, has to be General Motors. GM.
Oh, GM shares are absolutely surging up, what was it, 14.86% pre-market?
Almost 15% on huge volume, too.
It's extremely high volume. We're talking 44 million shares changing hands before the bell even rings.
And the catalyst is just a straightforward, strong Q3 earnings report.
Unequivocally strong. It didn't just meet expectations, it simply blew past them. It's setting a new benchmark, really, for profitability in the legacy auto sector right now.
Give us the numbers.
Adjusted EPS came in at $2.80. The consensus expectation was way lower, around $2.32.
Big beat on the bottom line. What about revenue?
Revenue was $48.59 billion. Also crushed the projection, which is about $45.02 billion.
They beat top and bottom. Anything else?
Yes, the icing on the cake. They raised their full-year adjusted EPS guidance by a substantial 11%, up to a midpoint of $10.13.
Wow. So that's a hat trick. Beat EPS, beat revenue, raise guidance.
It is. But here's the aha moment. This is what separates just a market summary from a real deep dive analysis.
Okay.
The market's excitement isn't just about those numbers. It's about the strategic pivot that CEO Mary Barra clearly articulated.
What was the pivot?
In her shareholder letter, she was refreshingly pragmatic. She acknowledged the current market reality, saying, and I'm quoting roughly here, near-term EV adoption will be lower than planned.
Okay, facing reality on EV speed.
Right. And crucially, GM announced it is reassessing its EV capacity build-out with the clear goal of reducing EV-related losses in 2026.
That's the profound signal the market was desperate to hear, isn't it?
That's exactly it. GM is being rewarded, lavishly rewarded, for shifting away from that speculative, capital-intensive, long-term EV growth narrative.
The narrative that's burdened so many auto stocks.
And focusing instead on maximizing current cash flow and profitability from their core business. The combustion engine trucks and SUVs that actually make money right now.
So this signals a complete strategic shift in what investors prefer right now.
Absolutely. The market is rewarding reality, rewarding cash, tangible profits today, over these pure, ambitious, but often loss-making EV growth stories.
That makes perfect sense. And this has immediate read-throughs, positive ones, for other legacy automakers with strong combustion engine profits.
It does. And conversely, it serves as a serious, painful warning shot for those cash-burning, pure-play EV startups out there.
The market has delivered its verdict. Profitability now, not 5 years from now.
That's the message. And as you said earlier, this sets up the ultimate contrast for the Tesla earnings report tonight. Huge implications there.
We'll definitely circle back to Tesla. Okay, let's look at another fascinating gainer. Six Flags, ticker FUN. Up over 17%.
Yeah, 17.73%. Quite a move.
And this isn't a story about better roller coasters, right? This is an activist story.
Classic activist pop. The stock surged right after the disclosure of a 9% investor group led by JA Partners.
JA Partners, they're one of the big, respected activist funds.
They are. And what makes this story a bit unique, adding some extra buzz, is the involvement of high-profile figures, including, apparently, NFL star Travis Kelce in this investor group.
Travis Kelce. Interesting. That definitely amplifies the public and retail investor interest.
Significantly. But for institutions, the key is Jana's involvement. It's usually a flashing green light.
Why? What does it signal?
It signals that Jana Nat, known for rigorous analysis, sees deep, untapped value here. They don't get involved unless they think they can force changes to unlock it.
So investors anticipate Jana will push for what kind of changes?
Aggressive strategic moves. Could be operational efficiency improvements, maybe selling off underperforming parks or other assets, or perhaps even pushing for a full sale of the entire company to maybe a private equity buyer.
Anything to unlock shareholder returns.
That's their goal. And the stock is being bid up today purely in anticipation of that action happening down the road.
Got it. Okay, now for a case study in conflicting signals, you said. Sionna Therapeutics, SION.
Yes, SION. Gapping up massively, 31.99%.
Wow. What's the news there?
This is a pure-play biotech catalyst. Genuine, positive clinical trial news. They announced the initiation of their Precision CF Phase 2A trial.
Phase 2. For their NBD1 stabilizer, SION 719.
That's the one. For a biotech company working on cystic fibrosis treatments, entering Phase 2A trials is a significant value-creating milestone. No question.
That sounds unequivocally excellent for a drug development company. So where's the dilemma? You mentioned caution earlier.
I did, because Sionna presents a perfect example of these conflicting signals that really test a trader's conviction.
How so?
While the scientific progress is undeniable, it's exciting. We have concurrent, heavy, and very recent insider selling happening.
Insider selling? Whew!
Just the day before this positive Phase 2A announcement, one of the directors, Bruce Booth, sold shares totaling about $3.04 million.
$3 million the day before good news. That sounds bad.
Well, context matters. Our source material notes this sale was done under a 10b5-1 plan.
Okay, pause there. Explain the 10b5-1 plan for our listeners. Why is that a critical technical detail?
Right. A 10b5-1 plan is a prearranged trading plan. It means that executive, or in this case the director, scheduled this specific sale months ago, often right after their previous earnings blackout period ended.
So it's not necessarily reacting to the immediate news.
Correct. The timing, while potentially awkward-looking, suggests it was likely planned for diversification or maybe personal liquidity needs, not panic selling based on some foreknowledge of imminent bad news or that this good news wasn't that good. It reduces the negative signal's urgency.
However,
There's always a however.
there is. The market often views any large executive sale, especially after a spectacular run-up. And remember, SIN was up something like 180% over the last 6 months.
Huge run.
As a caution flag. It forces longer-term investors, at least, to question the current valuation. Are the insiders signaling that the easy money has been made?
So you've got this strong short-term momentum from the clinical trial news, pushing the stock up 30%.
Right.
But on the other hand, you have those closest to the company taking millions in profits off the table after that huge run. Exactly. It raises that important question for anyone looking at it. Is this just a spectacular short-term trade based on the news momentum? Or is the long-term risk profile, given the insider selling and the valuation, simply too high now to justify it as a long-term investment?
A real dilemma. It forces you to separate the momentum play from the fundamental investment thesis.
Precisely. The momentum is clearly positive today, no doubt, justifying a trade perhaps, but that insider behavior strongly suggests increased caution is warranted for anyone thinking longer term.
Okay, good breakdown. Let's round out the gainers quickly. We saw other clear catalyst-driven wins, too.
Yes, Nuvation Bio and UVB, up almost 14%, about 13.78%.
What was their catalyst?
Clear international regulatory win. They got approval from Japan's Ministry of Health for their lung cancer drug, IBTRZA. Straightforward good news.
Okay. And VicrCore, VICR, also up strong.
VCR up 13.37%. They had a couple of things going on. They announced a major expansion of their intellectual property licensing practice.
How made?
Expected to contribute nearly $300 million in revenue through 2026. That's significant.
Wow.
And that news was compounded by a strong Q3 report and a separate $45 million patent litigation settlement in their favor.
So a rare triple dose of good news for Vicar.
Exactly. That kind of company-specific positive barrage completely overrides any macro concerns for them today.
All right, let's flip the coin now and look at the other, darker side of this market bifurcation, the losers.
Yes, the materials route. The entire materials mining rare earth minerals sector, it's experiencing a synchronized and pretty severe sell-off this morning.
And we need to emphasize again, this is largely not company-specific bad news hitting these stocks, right?
No, it's overwhelmingly macro-driven. It's tied directly back to that sharp, violent reversal in precious metals prices, especially gold that we detailed earlier.
When gold drops that fast, everything attached to it falls with it.
Pretty much in tandem, yeah.
Okay, leading the route today is Cleveland Cliffs, CLF. Shares down. Wow, 17.24%.
Brutal drop, down 17.24% on absolutely massive volume. We're seeing 67 million shares traded pre-market. That dwarfs their typical daily activity.
So what's going on with CLF? Is it just the gold price?
It's facing the perfect storm, really. They did report Q3 revenues, about $4.7 billion, generally seen as kind of lackluster, maybe a slight miss.
Okay, so earnings weren't great.
They weren't inspiring, but the post-earnings reactions being severely compounded, just blown out by the negative sector sentiment from the commodity collapse.
And analysts are piling on.
And that weak sentiment is being institutionally amplified by immediate analyst actions this morning. We saw a sell rating come out from GLJ Research and simultaneously a downgrade to underweight from Wells Fargo.
Ouch. So lukewarm earnings, a crushing sector headwind, and major analysts telling clients to get out.
That's the recipe for a precipitous drop like this. And the sheer volume, 67 million shares, suggests heavy institutional force selling, likely hitting internal stop losses just cascading lower.
Okay. If it's heavy institutional selling, that might mean the sell-off is getting overdone in the short term. But we can touch on that in the strategy section.
Good point.
Next up, core mining, CDE, plunging 16.11%. This one seems like an even purer play on the commodity price itself.
It is. It's really the epitome of high exposure. As a producer focused specifically on gold and silver, CDE is acutely vulnerable to that sudden commodity price collapse.
They don't have other businesses to cushion the blow.
No diversified revenue streams.
Yeah.
It's all metals pricing for them. And what's important to note here is that this vulnerability is amplified because the stock had been on such a tear recently.
Right, you mentioned that earlier.
It had just recently touched a 52-week high of $23.62. These stocks that go parabolic, these high flyers, they're often the very first ones institutions liquidate when the macro tide turns negative like this.
Why? Just locking in profit.
Primarily, yes.
Yeah.
They have the most built-up profit to protect. So when sentiment shifts, the selling is fast and furious, making the crash down seem even more dramatic.
Okay. We're also seeing major pullbacks in a couple of stocks that had just monumental, almost parabolic runs lately. Critical Metals Core, CRML, and USA Rare Earth, USR.
Yes, CRML is down about 16.91%, and USR is down 15.38%.
What's the story here? Similar to Core.
It's a classic case of massive profit-taking colliding head-on with severe sector weakness. CRML, it had surged a staggering 227% in just the past month.
227% in a month. Unbelievable.
And USR was up 116% year-to-date. When a sector rolls over this violently, investors sitting on triple-digit gains like that, they don't wait around. They are forced or feel forced to lock in those profits, often selling first and asking questions later about the long-term fundamentals.
So this isn't just retail panic selling. It's large funds de-risking these high-flying positions quickly.
Absolutely. And sometimes influential commentary can accelerate it too. Jim Cramer, for example, apparently suggested it was time for investors to exit CRML, which likely added fuel to the fire.
So these steep declines, they're really just the natural, almost mathematical consequence of that rapid parabolic growth hitting a sudden negative macro catalyst that forces liquidation.
Precisely. Gravity eventually reasserts itself, especially when the sector wind turns into a gale force headwind.
So the message from the losers list is clear. The materials sector is basically collateral damage from the sudden reversal in the precious metals trade.
That's the main story.
And the higher the stock flew before this rout started, the harder it seems to be falling today.
That's often the case. Higher beta names get hit hardest on the way down.
Okay, let's look ahead then, to the actual trading day and beyond. Let's reiterate the economic calendar situation first.
Right. As we said, it is almost entirely devoid of high-impact catalysts today.
What do we actually have?
We've got the NBA mortgage applications. That's at 11:00 a.m. Eastern. That might influence housing sentiment a little bit.
Okay.
And then later in the afternoon, 2:30 p.m. Eastern, we get the EIA crude oil stocks change report. That'll impact energy stocks. But that's really it for market-moving data.
And the emptiness of that calendar you said earlier is an extremely important strategic factor for today.
It is, because the absence of those major macroeconomic catalysts means that corporate earnings reports the beats and the misses. They're going to have an exaggerated and immediate impact today.
More so than usual.
Much more so. Every company's report gets scrutinized much more closely when there isn't a big GDP number or an inflation report competing for institutional capital's attention. The focus narrows purely onto the corporate microcosm.
Which makes our earnings watch list even more critical today. Let's go through the key names. Reporting before the market opened, so PMO.
Right, we've got some big players out already or reporting right now. AT&T, Thermo Fisher Scientific, TMO, CME Group, CME, Boston Scientific, BSX, and GE Vernova, GEV.
Let's focus on AT&T for a moment. What are people watching there?
Expected EPS is around 9.55 cents. That's actually down slightly from 60 cents last year.
Okay, so lower earnings expected. What are the key metrics?
We're watching three things specifically with AT&T. First, subscriber growth, both in their core wireless business and their expanding fiber internet service.
Growth numbers. What else?
Second, their progress on debt reduction. That's always a major focus for T.
And third?
And third, critically, any commentary around the sustainability of their dividend. That dividend is the main reason many investors hold AT&T stock, so any hint of pressure there would be very negative.
Got it. Okay, now for the reports after the market closed today, AMC. This is where some heavy hitters are.
Definitely. The list includes Tesla, TSLA, IBM Corp, IBM, Lam Research, LRCX, Las Vegas Sands, LVS, and QuantumScape, QS.
Let's look at IBM first. What's the expectation there?
For IBM, expected EPS is $2.43. That's actually a modest increase from $2.30 last year.
Okay, so growth expected. What will investors scrutinize?
They'll be looking closely at growth in IBM's higher margin businesses, software and consulting.
Any specific areas within those?
Yes, specific attention will be paid to their AI offerings, how that's ramping up, and crucially, the performance of their hybrid cloud solutions. Particularly, how is Red Hat doing? What's its revenue contribution and, maybe more importantly, its future pipeline looking like?
Okay, so IBM focused on software, cloud, AI. But the main event tonight, the one report that feels like it holds the potential to either confirm or completely deny the entire market narrative we've discussed, it has to be Tesla, TSLA.
Without a doubt. This report is nothing less than an absolute referendum on the near-term future of the entire EV sector.
Especially coming right after we saw that huge positive reaction to GM's pragmatic earnings this morning.
It is the ultimate A/B test for the market's investment thesis heading into 2026. GM provided test A this morning. Tesla provides test B tonight.
What are the key numbers for Tesla? What's the consensus forecast?
Consensus EPS forecast is just $0.41. Now, that's a significant decline from 62 cents in the prior year period.
Wow, $7.41 versus 62 cents. That's a big drop expected.
It is. So investors will be laser focused on a few things, obviously vehicle delivery numbers, but perhaps even more importantly, automotive gross margins.
Because those margins have been under intense pressure from all the price cuts, right?
Extreme pressure. They've repeatedly cut prices globally to try and drive volume. So the market needs to see where margins are settling. Any update on the Cybertruck production ramp or guidance on future pricing strategies, that will be highly market moving as well.
Okay, let's connect this directly back to GM again. GM was rewarded this morning for prioritizing immediate cash flow from its gas-powered trucks and essentially pushing back its aggressive EV targets a bit.
Right, for being pragmatic.
So if Tesla misses estimates tonight, or maybe even more critically, if they deliver cautious guidance about future production or pricing or margins,
it completely validates the market's newfound skepticism towards that near-term EV growth story that GM tapped into.
and the validation would be severe.
I think so. Look, if GM showed the market you get rewarded for being pragmatic about EVs right now, a poor Tesla result shows the potential punishment for pursuing those ambitious EV targets, perhaps at the expense of current profitability.
So a miss or weak outlook from Tesla could trigger a broader, painful re-rating across the whole EV sector.
I think it absolutely could. A decline in the valuation multiples applied to all EV stocks. It would likely benefit the diversified legacy players like GM even more, and it would brutally punish the pure-play EV startups and their suppliers, who rely solely on that aspirational high-growth trajectory.
So Tesla's report tonight isn't just about Tesla's stock price anymore.
Not at all. It's a fundamental test for the investment thesis that governs billions, maybe trillions of dollars across the entire global auto industry right now. High stakes.
Extremely high stakes. Okay, let's try to synthesize all of this as the opening bell gets closer. Where do we stand?
Well, today is clearly a high-stakes crossroads. It's defined by that profound divergence we keep talking about.
The bifurcation.
Exactly. You've got a powerful bullish signal coming from the Dow, from those old economy names like GM that delivered fundamental cash-heavy earnings strength. Real profits.
But that's fighting against.
It's fighting a loud, stark warning coming from the macro side, driven by that commodity collapse and also those lingering, hard-to-quantify financial credit concerns.
So the dominant narrative today is one of sharp rotation between these forces and very stock-specific volatility.
That sums it up perfectly.
Okay, so what are the key risks we need to monitor once trading actually begins?
All right, risk number one, as we just discussed, earnings contagion. A major miss by Tesla after the close tonight could absolutely sour sentiment across the entire technology sector, dragging down the NASDAQ and potentially overriding all the positive news we saw earlier today from GM or the biotechs.
Okay, Tesla contagion is risk one. What's risk number two?
Pay close attention to the possibility of a commodity overshoot to the downside. That sell-off in materials and mining this morning was so swift, so brutal.
Likely driven by forced liquidation and stops being hit.
Almost certainly. Which means it might be overdone in the very short term. So a quick intraday bounce and the price of gold or silver, maybe just stabilization, could cause a violent reversal higher in those beaten down mining stocks.
Creating a nasty short seller trap.
Exactly. Anyone who piled into short positions too aggressively this morning, chasing the downside, could face a very rapid squeeze if the commodity price just finds a floor and bounces even modestly.
Good point. Risk three.
Unscheduled Fed speak. Given the quiet macro calendar, given the data vacuum from the shutdown, any unplanned comments from a Federal Reserve official today about inflation or rate expectations could have an outsized, potentially massive impact.
Because the market is so sensitive to any news about that rate cut safety net.
Hypersensitive. Any comment that challenges those 53 basis points of priced-in cuts could really move markets today, much more than on a normal day with lots of data.
Okay, those are the risks. What about the opportunities created by this divergence?
Well, this setup creates some clear pathways for the active trader. First, the obvious earnings momentum plays. You might see follow-through buying in names like General Motors or Vickr as institutional capital seeks out that high-quality, confirmed momentum.
Makes sense. What else?
Critically, this bifurcation opens up perfect opportunities for relative value trades, what we often call pairs trades.
Explain pairs trades in this context.
Given the clear rotation we're seeing out of materials and into industrials, you could structure a trade to capitalize purely on that divergence continuing.
How?
A pairs trade would involve going long industrials, maybe buying a resilient name like GM or perhaps an industrial sector ETF, while simultaneously going short the materials sector. You could short a vulnerable name like Cleveland Cliffs or a materials ETF like XLB.
And the benefit of that.
This strategy aims to insulate you somewhat from the overall direction of the market. Whether the S&P goes up or down, you're trying to profit specifically from the spread between industrials outperforming materials. You're betting on the rotation itself.
Interesting strategy for this environment. So, the bottom line takeaway for you, the listener, today seems pretty simple.
What is it?
Passive index investing is probably disfavored in this kind of environment. When the market is this highly bifurcated, just holding an S&P 500 ETF means you're essentially holding one winner for every loser, netting out to maybe not much.
Right. The average hides the extremes.
Success today hinges entirely on identifying those individual winners and losers and intelligently navigating this ongoing powerful rotation between, say, growth that delivers profits now versus more speculative growth that might still be burning cash.
Well said. Active management, stock selection, understanding these cross currents, that's key today.
All right. That leaves us with a final provocative thought, perhaps, for people to consider as they navigate the day and the week ahead.
Let's hear it.
We've established that the market's resilience, particularly the Dow's record highs, seems heavily reliant on that safety net of anticipated Fed rate cuts.
That subsidized valuation we talked about.
Exactly. So given the structural reliance, this subsidy,
Yeah.
how structurally sound are today's record highs, really? And maybe more importantly, what might be the true long-term cost to market discipline, to price discovery, of valuing a monetary promise from the Fed over fundamental, unsubsidized operational strength from companies?
That's a deep question. Essentially, are we building the foundation on solid rock or on the shifting sands of Fed expectations? And what happens when the tide of monetary policy eventually turns? It's a question that really defines the next few quarters, maybe even years, of policy and investment strategy.
Absolutely something to mull over as you place your trades or adjust your portfolio. Thank you for joining us for this deep dive into today's complex market briefing.
Thanks for having me. Lots to watch today.
Definitely. We encourage you, as always, to continue exploring your own source materials to stay ahead of the curve. We'll talk to you next time on Bulls, Bears, and the Bell.